Okay, good morning or good afternoon, everyone, and thank you very much for joining us on this webinar with Lift Financial. On behalf of the CLA, I'm delighted to welcome you to what I'm sure will be an informative and interesting event for you today. My name is Anne Maidment, and I'm the Director for the Southwest region for the CLA, and I will be the chair for today's webinar. Today, we will be introducing you to Lift Financial. This is one of our many member offers that we have within the CLA. Over the coming months, Lift Financial will be holding 3 webinars for CLA members covering a variety of topics associated with areas of financial planning. The CLA have teamed up with Lift Financial to help members in understanding your options and making the most of your money, and highlight what you need to consider when planning for a financially secure future. In today's session, we will hear from Daniel Barrett from Lift Financial, and this session will be recorded and will be available on our website in due course. Please do feel free to ask as many questions as you wish at any time using the Q&A button at the bottom of your screen. We'll endeavour to get through as many as we can, and we will ask for any questions at the end of each section of the presentation. Any that we don't get to today, I'm sure Daniel will be happy to answer after the session. So I'm delighted to introduce you to Daniel Barrett, Chartered Financial Planner, who will guide us through the options in an introduction to the financial world. So I'd now like to hand you over to Daniel.
Thanks, Anne. Thank you very much for that wonderful introduction. Today is really just an introduction about Lift, how we're going to fit in with other CLA services that obviously CLA offer to members, and just hopefully try and provide as much information as possible to people and be as informative as we can be about why you might want to have a conversation with us and hopefully how we can help. Starting off a little bit about me, I will try not to go on about myself too much today. But yeah, as mentioned, Chartered Financial Planner, a fellow of the PFS, which is the Professional Finance Society. That's the highest qualifications you can get in our industry. So everybody at Lift, all the various advisors are chartered and are working towards fellowship or already as well fellows of the PFS. We try and work on an individual basis with individuals or with families, and really just try and understand exactly what you want to achieve. And hopefully today I'll kind of expose a few things that you might be thinking about, or you're probably already thinking about, but maybe want to find out some more information. Just on Lift, so we were established in 2007 by Joel and Mike. There was 4 people at that point. We're now at 115 people, between 110 and 115 depending on which day you do a head count. We've got offices across the UK, so we've got an office in the city in London, there's one in Manchester, and there's one in Edinburgh, but we also as well have local advisors who work from home, so pretty much the whole of the country. You can either meet someone in person at one of our offices, or again, obviously with the way the world's gone, we can obviously do a lot of things virtually now. We've won numerous awards, don't want to go on too much about them, but again, we're kind of well qualified, well recognised within the industry, really highly qualified, looking to obviously hopefully give you a lot of information today to proceed with financial planning. One mention as well is our mortgage team. Really good, hence why they've won the best broker firm for overall quality. It's quite a small team, but we're punched well above our weight. We're kind of one of the biggest mortgage brokers in the country. So again, if you've got any sort of needs, either just normal residential mortgages, buy-to-let properties, or any sort of specialist lending, maybe on outbuildings and farms, and there's lots of different specialist lending, we can definitely help and assist with that as well. So without further ado, we're going to start on pensions, which is sorry, we're going to talk about why clients use our services, getting ahead of myself there slightly. So just trying to come up with a few scenarios as to why people come to Lift. Most people find out about Lift through these types of sessions, so it's not just the CLA that we run these for, sort of big investment companies in the city, as well as insurance brokers and a few other places. So that's where we tend to kind of get our name out there a lot, is by running these types of sessions, providing information, and hopefully getting people interested in becoming clients. But some of the main things that people come to us with is that they might have a complex tax situation. So you might have sort of deferred bonuses or share rewards, those sorts of things, which can get quite complicated. Lots of things we can help with there. You might be a business owner, so kind of structuring dividends and pension contributions and those sorts of things. So any sort of complex tax situation that you might have, generally speaking, there's probably some sort of solution that we can help and assist you with. The next, you might have come into a bit of money, lottery, inheritance, big bonus, whatever it might be, and kind of might be the first time that you've had such a large amount of money, and wondering, sort of maybe you've spoke to a few friends and they've said, oh, you should be investing, but just don't know where to start. So that's generally where we'll try and help a lot of people there. Buying a home or any sort of property related thing, so it might be getting on the property ladder, it might be buying the next family home, or maybe even downsizing towards the end of your life. You maybe want to, you're releasing capital and wondering what you should do with that money as well. So any sort of property related queries as well we tend to get. And also as well, maybe you've just started a family, or you've got to a point where you want to consider about them in the future, maybe school fee planning, university fee planning, getting them on the property ladder, more marriages and weddings and things like that. Lots of expensive. As children, we are quite expensive. So yes, just that might be a reason that someone would come and speak to us. But as I say, there's a breadth of reasons, and really it's just about if you've got something that you want us to help you with in terms of anything financial, we probably can. Now we get onto the kind of the main thing of what we focus on. So most people will come to us and they'll want us to help them mitigate against the three main taxes, which are income tax, capital gains tax, and inheritance tax. And I'll cover all three of those later in the presentation. What I think differentiates Lift slightly from maybe your traditional financial advisor is our focus more on planning for your future. Obviously, we deal with the now, so all the technicality or the practicalities of situations immediately, but it's also about really trying to get a true understanding of where you want to get to, and how best we can use various tools to get you there. So it's a real good understanding of what you have and where you are, but also where you want to get to, because it's quite hard to tell somebody what to do with their money without knowing where they're heading. So that's kind of the real crux of what we try to do. Of course, we can help with recommending ISAs and helping invest money, but it's really more slightly deeper than that. It's all about looking at your situation holistically, which is why we work quite well dovetailing in with other professional services like accountants and solicitors. So I know that the accountancy partners at CLA is Safri's. We work very closely with them already, which is quite helpful. So again, it would probably, if you do use those services, we probably already know your accountant, so we can help and we can have joint meetings. A lot of my meetings tend to be with another financial professional service, whether, like I say, that's an accountant or a solicitor, and it's really about looking at the whole situation and trying to get the best out of what you have and get you to where you want to be. So moving on to pensions. Yes, there we go, got there. The most things with pensions is probably our big specialist subject. It's things that I deal with it on a daily basis. Tend to get some referrals from accountants where they kind of know the rules around pension funding, but maybe don't know which pension they should be funded or how that money should be invested, and that's where we tend to fit in quite nicely. So we would help with the kind of the structuring of the pension, so what type of pensions you should have, which ones are better than others, and also as well then which provider you should use. So there's kind of there's a two-layer approach there. It's kind of knowing which structure you should use and then which provider should I use after that, because there's a whole host of options at that point. Generally speaking, what I would say is about 90% of our recommendations generally fall within a SIP, which is a self-invested personal pension. Probably, in terms of familiarity, most people seem to be kind of aware of what they are and those sorts of things. So what is a SIP? A SIP is just a pension. It's ignore the self-invested part. Traditionally, it used to be, but you don't have to self-invest anymore. And what you're looking at is it offers you the most flexibility in terms of investment options, the most flexibility in terms of when you actually retire, how you access your money, and also as well, the most flexibility in terms of passing on your pension wealth after you die. There's been a whole shift in pensions away from using them to actually give you a retirement income and start using them as vehicles to pass wealth down to the next generation. So again, if there's something of interest to you, please do obviously feel free to get in contact. At the end of the presentation as well, there's an email address that you can email, and you'll then we can arrange a one-on-one appointment if that's interesting. So we've got SIPs, and sometimes as well there's situations where a self-administered small scheme or a SAS is more applicable, and these kind of hit the news in the sort of the late noughties, early tens, and basically it's only really applicable for people that are business owners, and again the number of members is going to be it has to be under 10. But there's some quite clever and quirky things we can do with SASs, such as moving business assets into the pension. So if you've got, I don't know, an office building or some sort of building that you kind of at the moment the business owns, you can move that into the pension. The pension then owns that asset. You as a business can then pay rent on that property, which classes as pension contribution. So what that does, it moves the asset into the pension structure, which is free of inheritance tax, and also as well it starts a regular contribution from the company into your pension pot for the future, when obviously maybe you'll sell the business, and it'll give you then a number of options with flexibilities and those sorts of things. So lots of sort of clever and quirky things we can do with SASs, but it's quite a small niche area. But again, if you are a business owner or you're a director, feel free to get in touch and we can kind of go through the particulars of that. Family pension funding strategies. I've done quite a few of this over the last couple of months because it's the 6th of April is the new tax year, so happy new tax year, everybody. But yeah, over the last couple of months, done quite a lot of this where there's a small business, maybe they've kind of done a property development on land or something along those lines, and they've just realised a huge amount of money in the business. One things we can actually do is actually make an employer contribution into a pension structure, which is a business expense, so it's tax deductible, gets the money into a pension asset, we can invest it, and also as well the family side of things. Obviously, if you've got a spouse as a director of the business as well, or is actually a working director, then that can help. But also as well, you can have children as well as not necessarily directors, but as employees of the company that we can then actually make an employer pension contribution from the business. So some nice clever things we can do there as well. As I alluded to previously, pensions are free of inheritance tax. So if you inherit a pension, there'll be no inheritance tax. It falls outside of your estate. There were some changes in 2016 around pensions flexibility, and one of the main sort of benefits, or one of the main things that we use on a fairly regular basis, is you can transfer the pension to maybe a spouse, and they can actually inherit that as a pension pot. What that will do is that on the spouse's death, then they can then pass that down to the next generation as a pension pot, and again that avoids inheritance tax. The next generation can receive that as a pension pot, and again they don't have to be of pension age, they can be under pension age, and they can draw money out of it as and when needed. But what you can then actually do is you can then pass that, they can then pass that down to the grandchildren, and so on and so forth. So realistically, it's just a really helpful way to begin to start passing wealth down intergenerationally through pension structures, which wasn't there previously. The other main thing that tends to come across with pensions is consolidating various workplace pensions. So people change jobs, it's just the way of the world. You may have amassed 4 or 5 different pension pots, and it's kind of then going through and helping you with, do you consolidate those, what do you do with each of them, what are they actually worth, etc., etc. So that's generally helpful. If we go on to the next slide, I think we've got a short slide just on pension funding rules. So this is quite technical or complicated. So again, if any of this is applicable to you, please feel free to get in contact with us and we can go through your individual situation. But these are the rules. So You have an annual allowance for pension, which is the most you can pay into pensions. That's £40,000 a year. Everyone can pay that in. What happens is if you're actually earning over £240,000 a year, which is obviously a lovely position to be in, but it is fairly, well, it can happen, you start to lose that pension allowance by a tapering effect. So every £2 of income above £240,000, you lose £1 of the pension allowance. So to give you an example, if your total income in the previous tax year was £260,000, your pension allowance, because you were 20,000 over the threshold, is £30,000 because you reduce it by a 2-to-1 ratio. That carries on until you earn over £312,000. Once you exceed 312, your pension allowance is capped at £4,000. So some rules there, but in terms of the practicalities of that, what does that actually mean to you? Well, clearly, as you start to earn more money, and maybe you then go, well, I can start thinking about putting money into my pension, the government stops you being able to do that. So sometimes it may make sense to really focus on pension funding before you get to that point, assuming you get into a position where you do reach that that earning threshold, so that your pension pot is kind of funded and done, because you will eventually be caught out by the taper on your allowance. You can carry forward unused pension allowances from the 3 previous tax years. So what that does is it gives the opportunity, and it says here, of a larger lump sum contribution, potentially up to £160,000 in 1 year. And again, you can do that per person. So when I was talking about family pension planning or family pension funding, if you are perhaps, as I say, a business owner that's maybe sold an asset within the business, and you've got a huge lump of money that you're about to pay 19% corporation tax on, you could, if you've got 2 directors, £320,000 into a pension that's tax deductible from corporation tax, and then also as well gets money into your pension as well, that builds obviously for your financial future as well. So that's just one opportunity. Again, if you've got children as well, they can, as employees, they can also benefit from this. So it's a real kind of niche opportunity, but one that I thought might be worth pointing out to members. So changes in the pension funding rules have given kind of scope for higher contributions, or maybe making sense about that. So just if you want to put any questions in.
Yes.
Go on, sorry, Anne.
Thanks, Daniel. Yeah, no, I'll just pause there. We have had one question in from Caroline saying, I know a bit about SIPs and the lifetime allowance, but what's the situation about SAS and the lifetime allowance?
Well, as I said, SAS did rise to prominence because you could do some quite clever, quirky things, and it's the same, so it doesn't matter. So SASs are treated in exactly the same way as SIPs. And previously, you could do disproportionate growth. I don't know why I'm telling you this, because you can't do it anymore. So they're exactly the same. SIPs and SASs are exactly the same in terms of the treatment for the lifetime allowance.
Brilliant. Thank you for that. I think, should we probably move on to the next?
Yeah, no, it's fine. As I say, if there are any other pension questions, we will do a Q&A session at the end, but I just thought we'd try and make it as interactive as possible. So yeah, we'll go on to the next slide. So the kind of going to go through each individual tax allowance. So we've got income tax, capital gains tax, and inheritance tax. I was actually at the CLA conference in Westminster just before Christmas, I think it was, and everyone that I actually spoke to wanted to talk about inheritance tax. So I imagine that'll be a lot of questions. So I'll try and leave as much time as possible on that. But if we move on to start with income taxes. So everyone knows what income tax is. If you earn some money, you've got to pay the government. There are thresholds and different bands, but the main one that I wanted to talk about is actually the 0% tax band. So if you the first part of your income, so the first £12,570, is actually taxed at 0%. Now that allowance is actually lost as you start to earn over £100,000. And if you earn over £125,000, 140, thanks Rishi, then you lose your personal allowance completely. Now there are some things we can do with pension funding and a few other different tax allowances, where we can, if your income's floating around between 100 and say 125 or 130, or somewhere between 130 and 100,000, there are some quite clever things we can do where you can actually reclaim that personal allowance. So again, if you are in that situation, it's probably definitely worth sitting down with one of our advisors and just running through the options for you about what the actual things we can do to help you. Other ways to try and sort of mitigate against income tax, because it's PAYE for most people, it's quite difficult to do much. But if you are maybe a business owner, there is opportunity to maybe shift income to lower earning spouses and or children. So you could make family members shareholders or partners in the business. You don't have to give them full shares. They could be different classes of shares, and where they may be entitled to a dividend, but maybe not the capital of the value of the shares. Lots of clever things you can do. And again, we'd sit down with an accountant and help you structure those things. But again, if you can kind of, instead of one person taking all the income, if you can spread that load because of the way income tax works and the fact that it's marginal and it's banded, then what you'll see is obviously everyone pays a lower rate of tax rather than one person going through the various bands. There is a marriage allowance. So the marriage allowance allows you to claim 10% of your non-working spouse's personal allowance. You have to be a basic rate taxpayer, otherwise you can't actually claim that. But again, it's just a way of getting £1,257 extra tax-free income. So just a little clever trick that not many people know about. The other thing as well is junior ISAs. So I'm going to assume everyone knows what an ISA, but I'll quickly explain what they are. Individual savings account, you can have a cash ISA or an investment ISA. We tend to always use investment ISAs, especially with interest rates at the moment. Now, junior ISAs are exactly the same, but it's exactly what it says on the tin. It's for a junior, so under 18, you can actually set up a junior ISA. You can contribute up to £9,000 a year into those. And I tend to use them with clients to help sort of think about university fee planning, because they get access to the money at 18. What happens at 18? Generally, well, you can go to university, depending on gap years and desires and all the rest of it. So the idea would be to try and build up sort of £50,000 into a junior ISA pot to then afford to kind of cover the cost of university. Obviously, that's just a standard 3-year course. If you're doing doctor or architecture or whatever it might be, then we need to plan for more. But really, that's when we would tend to try and use junior ISAs. The other way that we look at inheritance income tax, is rolling up income in vehicles which suffer lower rates of tax. So there's family investment companies. I won't go on to those too much because there's a slide on those individually at the end of the presentation. Offshore bonds. Offshore's got quite a dirty name. I'm not saying you should set up an account in Panama in your dog's name. This is under UK legislation, probably investing in the Isle of Man or Dublin. You HMRC know about it, you declare it every year, but what the benefit is of the offshore account is you actually can roll up any income or investment returns and choose when you actually pay the tax on those. So some quite clever things we can do with those around school fee planning and a few other bits and pieces. And another thing as well is forestry. So commercial timber is any sort of income generated from commercial timber production is completely free of income taxes. So forestry is kind of you'll see it featuring all three of these next slides. But yeah, it could be of interest to a few of you depending on your situation. But I just thought we'd mention it. I don't think have we had any questions on the income tax side of things?
No, there was one question that we had in advance, which was, so what are the best ways to reduce my income tax bill?
Yes, good question. So as I said, it's fairly difficult with PAYE to actually sort of alter your income. So the best way that we found it is actually through pension funding. So every contribution that goes into a pension, you attract tax relief at your marginal rate. So you could fund a pension and whatever you put in, you would get either 20, 40 or 45% income tax relief on those contributions. So one of the best ways to reduce the amount of tax that you pay to the government is actually putting money into your pension, plus all the benefits of pensions. As I said before, everybody should be putting money into pensions.
Thanks for that. Great.
So yeah, if we move on to capital gains tax. So CGT, we do love an acronym. If there are any acronyms that I've said that you don't quite follow, please just put in the chat and I'll explain what they are. I've tried to avoid them as much as possible, but sometimes it is quite hard. So capital gains tax is a tax on capital gains. So if you've got an investment or a property that's not your main residence, then the gain that you make when you sell that is liable to capital gains tax. Now, everybody has a CGT allowance or capital gains tax allowance, and that's £12,300. And that was for 21-22, and that's not changed. It's still this 12,300 for 22-23, which we've just started. And what that means is you can make a gain up to that amount and there'll be no capital gains tax to pay. Now, allowances applies to each member. So if it's an investment account, for instance, then we could maybe look to add a spouse or maybe a business partner or somebody, depending on the individual situation. But every person that owns a portion of that gets their £12,300 capital gain. So again, if you've got adult children, perhaps you could add them onto the account. If it's a property, you could add them onto the deeds, as long as it's not a mortgage, because that creates a few complications. But yeah, lots of ways where we can then maybe try and spread the ownership so everyone then gets that £12,300 allowance. Again, there could be partial gains that you can make and try and make the gains over numerous tax years. So yeah, lots of different things we can do there. If you do make a gain, there are two tax rates. If you're a basic rate taxpayer, you'll pay 10%, and if you're a higher or additional rate taxpayer, you'll pay 20%. Now, those rates differ slightly on property. If you're a basic rate taxpayer, that's 18%, and if you're a higher or additional, that's 28%. So much lower than the income tax penalties or taxes, I should probably say. But equally as well, it's still something to consider. Any gains that you make within pensions and ISAs are not subject to capital gains tax. So again, if we're kind of creating a holistic investment plan for somebody, we're looking to probably take more risk in the ISA and the pension, so that if you do make the gains that we're trying to make, there's no capital gains tax on things. And if we're trying to do some more cautious investments that are maybe not going to make as much of a gain, then you would look to make those where there's not the CGT free section. Forestry, again, if you sell the business and or maybe some of the land, you will pay CGT on the land, but the actual value of the timber or the trees, there's no capital gains tax due on those. And then just to kind of explain where LIFT generally fit in with investing money, I would say we can help and advise on investing money generally from about £100,000. So the way LIFT charge is based on the time that we spend with somebody rather than kind of the archaic percentage-based fees. So what that means is there is probably a minimum level of investment, but if you've got any more than that, and especially at the higher ends, then we do become very, very competitive. If you do have money, maybe that have got clients where we started with less than that, but there was a regular pattern of maybe starting out in their career and we're building up funds. But if you've just got a lump sum, if it's probably just going to be £100,000 or it's not really going to make too much sense, really. So that's capital gains tax. If you have got any questions, pop them in the chat, or I think we've had a question through as well.
Yes, we've just had one in actually. So it was actually a question about pensions. What I might suggest actually, Daniel, if you want to continue, and we can do that one at the end.
Yeah, makes sense.
Thanks.
So we move on from capital gains tax and go on to inheritance tax. So there are 3 slides on this. So it's kind of going to be the main part of the presentation, but hopefully try and leave as much time as possible for the questions as well at the end. So inheritance tax is a tax on money that is inherited. So most of these taxes do what they say on the tin. It's kind of seen as probably one of the more controversial taxes. I mean, you've earned income, you've paid tax on the income you've earned, you might have made some investments that have made money, you've paid capital gains tax on those investments, and then when you die, you have to then pay an inheritance tax on the whole value of everything. It is seen as kind of probably one of the more controversial taxes. Now, there is a nil rate band. So what that means is if your estate is worth up to this amount, you won't pay any inheritance tax, and you only pay inheritance tax on the amount over this nil rate band. So and again, obviously if you're a spouse or if you're married, or in a civil partnership, you'll actually be able to inherit the other person's nil rate band. So for most people, If they're married, you'll have £650,000 of your estate that you can pass on to whoever you want without actually having to pay any inheritance taxes. There is a main residence nil rate band as well, which can bring the total value that's at a nil rate band up to £1 million. And there's lots of sort of weird rules around that. So if inheritance tax is something you want to, I'd suggest probably just having a conversation with one of the advisors at Lift just to go through your personal situation. But this is a sort of an overview of what we should be considering. Ways to reduce your IHT burden. There are probably 5 or 6 different ways. I've tried to think of as many as possible. The first one that I always enjoy telling people is spend it. If you want to kind of avoid paying inheritance tax on money over a certain amount, then the best way to do is spend the money that's over that certain amount. So the way that Lift charge kind of differs, as I mentioned, it's all based on time. So you probably wouldn't hear too many financial advisors encouraging you to spend the money that you've worked hard to build up and save. But because of the way we charge, I can sit there and tell you that one of the most effective ways of reducing your IHT liability is actually spending some money and enjoying it. Probably one of the next steps will be looking at gifts, so gifts throughout your lifetime. And on the next slide that we'll go to in a minute is kind of the rules on the different gifting sections. So I won't spend too much time on that. There is an option as well where you could insure the liability. So if you had an inheritance tax liability of say £100,000, Lift could help organise an insurance policy for you where that would pay £100,000 to your beneficiaries when you die, and then they can use that money to pay the tax liability, and then the actual assets that you owned still remain intact and they can be passed on to your beneficiaries. The other one as well is there are ways to own IHT efficient assets. So they tend to be assets that attract business relief. So that could be an AIM share portfolio, could be forestry, could be a number of different assets as well. Again, if that's something of interest to you, I generally say speak to Lift first. You can do some planning in your wills, so you can create will trusts, you can create trusts ahead of your death as well, all of which would probably be with a solicitor. But generally speaking, if you're looking to clarify a situation on inheritance tax, I would sit with a financial advisor first, who would then be able to maybe kind of, as I say, recommend maybe Safri's for the accountancy side, that one of the in-house CLA solicitors could help with writing the will and those sorts of things. So yeah, generally speaking, we'd start there and then go from there. And another way of doing it is keeping assets in a business, which would generally be an accountant. So if we look at some of the ways that you can gift money, which is on the next slide, you've got 3 different types of lifetime gifts. So you've got exempt gifts. So these are gifts that you can make on a regular basis that are actually completely free of inheritance tax. So gifts to spouses or registered civil partners are completely free of inheritance tax. You can gift up to £3,000 a year, and you can actually carry forward 1 year's worth of that gifting allowance. So if you've never made any gifts before in the first year, you can gift £6,000. And this is per person as well. You can make small gifts of £250 per person per annum. And you can also make sort of higher gifts on marriage. So that can be that can be sort of to your children, you're allowed to do £10,000, grandchildren, I think it's £5,000, and various other allowances and those things. One thing I definitely want to speak about is just gifts to UK charities. So if you want to make a gift to a UK charity in your will, and again, the solicitors probably would help explain this to you, if you give 10% of your estate, it actually reduces your inheritance tax rate from 40% down to 36%. So generally speaking, if you're thinking of maybe making a gift to a UK charity anyway, probably worth maybe making sure that that number reaches 10%, so that you can then benefit from the lower rate on the rest of your estate. You can also as well make gifts as part of your normal expenditure. So if you've got a clearly defined sort of level of living, and you've got a regular income coming through, what you can do is the difference between those two numbers you can give away annually each year, and there's no sort of that's allowed. We then move on to potentially exempt transfers or pets, and most people probably have heard about some of these things. So you've got the 7-year rule. So if you make a potentially exempt gift, which is generally transfer of assets to somebody else other than your wife, you have to survive 7 years. If you do, then there's no inheritance tax, and there's a taper between the 0 and 7 year rate. Then you've got chargeable transfers, which are gifts to discretionary trusts, where the value of the transfer actually exceeds the nil rate band. If you're doing any of that, you should definitely be taking advice. So going on to the next slide as well. I think we had a question about agricultural relief, so we're going to touch on that. Many take advantage of familiar relief, such as business relief, which I talked about, and also agricultural property relief. So both of those types of assets benefit from free of inheritance tax. Business relief applies only to trading businesses, so it's not relief for any investment companies or maybe property businesses where there's maybe lots of buy-to-lets in there. But it has, if it is a trading company, then you will benefit from the business relief on that. And relief is given for popular land such as forestry and a few other different agricultural land options. But again, if that is applicable to you, let's sit down, let's make sure it qualifies, let it be with an accountant, probably a solicitor as well, and just making sure that we know exactly what parts of your estate are actually liable to inheritance tax. Yeah, so that's inheritance tax. I kind of whistled through that because I want to get more to questions than anything else. So if there is anything that you haven't quite understood, please feel free to ask a question now, and I'll try and get through through as much as possible.
Great. If you want to do the last section, Daniel, and then we'll take all the questions at the end.
Fine. Makes sense.
Brilliant.
So the last slide, yeah, great, thanks, Anne. So the last slide is family investment companies. This is, I mean, it is entirely applicable here. So it avoids some of the inheritance tax charges which apply to larger family settlements. The way that we can do that is by creating an investment company. You can have, that can be a previous trading company. So if you kind of retired and still maybe not actually actively carrying out the business, and maybe you've not sold the business, the assets in there, we can then kind of create a family investment company from, or we can start from scratch and create a family investment company from the beginning. Lots of different ways to fund it, really complicated, but again, you can do direct loans, you can do just share capital, huge different ways of actually being able to go through and do that. If it is a trading company, obviously it does attract business relief. It's really popular for kind of big family investments as well as intergenerational planning. So you can have different share classes. So maybe children would be shareholders when they're younger, and as they get older, and just before maybe you, again, thinking about that 7-year rule as you're getting closer and closer to death. Fun topic for Wednesday afternoon. But yeah, as you get closer and closer to death, you can maybe then give up your shares or transfer the ownership of your shares to your children. They can then kind of become the owners of the family investment company, and then the grandchildren can be, again, the other share class holders, and so on and so forth. So again, if this is of interest to you, I would generally say it's only really applicable if you're looking at maybe 1 to 2, well, at least 2 million, I'd say, and above. This is where this comes in really helpful. But again, it's something that if that is applicable or interesting to you, we'd start with a conversation about it, and then we'd go from there. There's so much I could talk. I could do a whole presentation on family investment companies, so I'll try and leave that there, and we'll go on to the various questions that we've had.
Brilliant. Thank you for that, Daniel. So we have had a few questions come in. I might just start with Caroline. So we've got, would relief be available for a holiday let business or a buy-to-let business?
So holiday lets are slightly different to your traditional buy-to-let mortgages, buy-to-let properties. If you've got a company with a load of buy-to-lets in there, that's not going to qualify for business relief, because it's not, whilst obviously you're probably trading, it's just a company that's got a load of assets in there, so that isn't going to qualify. But again, as I mentioned, what you could probably do if that is the situation is look more towards this family investment company solution, or a FIC, where you can then look at different share classes and pass wealth down that way rather than qualifying for business relief initially. The holiday let side of things is slightly different. That is classed as a trading business because you generally run those on a sole trader. So if you want to get into the practicalities and technicalities of it, it's probably best we have a sit down meeting and we can go through them all individually. But yeah, the holiday lets are treated differently to traditional buy to lets on sort of long-term contracts.
Okay, perfect. Thank you. We had one from Susie who said, please, can you tell us what other assets fall into popular land? Which is something
not off the top of my head, but I think sort of like bridleways. To be honest with you, it's much easier. If you go on to the HMRC web or the Gov website, there's a list of those types of lands that are quite clearly defined. It's like land that people can enjoy. So if you allow ramblers to go through it, then technically the whole field can be classed as a popular. It gets really particular. So I think if you want to, I'd happily sit down and go through your individual case and say that probably is qualifying, that isn't. And again, it's going to be sat down with an accountant as well in that meeting as well, just to that's their main area of expertise rather than ours. So there's a number of different pieces of land, but I just thought, yeah, if we'll talk about your particulars maybe in a separate meeting.
What I should probably add, which I should have said at the start, is obviously we have, as part of CLA membership, free and unlimited advice, and we have a tax team here in the London office who can also advise members on things like this, so
yeah,
which will complement alongside what you're doing. So,
yeah, no, exactly. I mean, it's Safri's as well. So if we are talking about those sorts of things, I would generally have an accountant with me, because that's clearly their area of expertise. So if members get that advice for free anyway, then I'd probably pick that up with them.
Yeah, perfect. So moving on to a subject which actually we do a lot of work with the CLA at the moment. Annie has asked if there's any more clarity on the tax treatment for carbon trading, and also biodiversity net gain covenants, which is something that's coming in later next year with regards to offsetting of planning and development. So.
Yeah, not that I've seen. No more real clarity, unfortunately.
Yeah.
So yeah, as soon as there is, I'm almost certain we'll either do an article in the magazine or maybe do a webinar or something along those lines.
Yes, please do reach out, Annie. We're also working on that too. So we're all looking for more clarity in this. It's so many new markets at the moment. Yeah. So we also had a question in about a pension question and whether there's an age limit you can pay into a pension, specifically a SIP. So in the situation that income is relatively low, e.g. 10,000, can you sell assets capital to pay into a SIP up to, say, 40,000 level, as you mentioned, or is the amount limited to the income, your income for that year?
So there is an age limit. So let's take that point first. 75 is the limit. Now, there's no actual legislation that says you can't contribute after 75. The problem you've got is that most pension providers won't actually practically allow you to do it after 75. So the easiest answer to that question is 75. Is there a situation? So so yes, you can actually contribute above that £40,000 limit I was talking about. The reason that what you won't get is tax relief on the amount over the 40,000. So if you contributed above 40,000, whatever your personal annual allowance will be, you can actually contribute more than that. It's just that you don't get the tax relief. So it doesn't really make too much sense to do that practically, unless you're looking at it from an IHT perspective. So yes, you could, if you wanted to, sell capital and make a contribution into your pension above the £10,000 income that you've got at the moment, but you wouldn't get tax relief on that contribution because you haven't paid enough income tax to you would get a little bit, but you wouldn't get it all the way. Now, there are some very good situations where that probably still makes sense, especially if you're looking to avoid inheritance tax. So I think it's one where, yes, you definitely can pay over the allowances. It's just that it usually doesn't make sense, but there are situations where it does. And I think it probably would be just beneficial to sit down with one of the LIFT advisors and go through your, again, individual particulars.
Brilliant. Thank you very much, Daniel. Well, we've come to the end of our time for today. There was a huge amount of information in that. And as I said at the start, this will be recorded, has been recorded and available on the website. So if anyone would like to watch back and make more notes, then please do feel free to do so. You can also contact Daniel afterwards. I'd be happy to answer any more questions that you might have. And also just to let you know, obviously we have events both in person, and we've got 2 more webinars with Lift Financial with the CLA. So do have a look on our website. We have a range of events coming up, including our AGMs and shows as well for the spring and summer months. Thank you very much, Daniel. It's been very interesting. And also, if anyone has any other questions, please contact your regional office and we can offer some advice and point you in the right direction as well. So we'll leave it there. Thank you very much, and thank you for joining us. Bye.